All right, good afternoon and welcome. Thank you for joining us this afternoon. My name is Brian Humphrey. I'm the Director of Distribution for Advisors Preferred. We're a sub-advised fund family. We're pleased to be hosting this series of webinars with the theme of From Chaos Comes Opportunity. 2020 has been quite a year so far, but at Advisors Preferred, we are proud to have managed to have fared very well during these difficult markets. It is my great pleasure to introduce Michael Price and Lee Harris from Price Capital Management for today's call. Based in Florida, Price Capital Management is the portfolio manager for the Ontrack Core Fund. The fund is currently ranked 5 stars by Morningstar in the multi-alternative category and is up over 21.5% year to date. We feel this is quite an accomplishment, and we're eager to hear from Michael and Lee. We'll get started in just a moment, but first a couple of housekeeping items. We will be having a question and answer session following the prepared presentation from Michael and Lee at Price Capital Management. So if you have any questions, please feel free to submit those through the question and answer interface in the Zoom webinar. Secondly, we are recording this webinar so we can make it available to you afterwards. Now, we also need to take just a moment here and look at a few disclosure slides from our friends in compliance. And if we could, there we go. Oh, moving a little bit too fast. And I think there's one more slide we need to take a look at. There we go. All right, great. Now that we've got those formalities out of the way, it is my pleasure to hand things over to Michael Price and Lee Harris for post-bear market strategies.
Good afternoon. This is Michael Price. I'm the co-manager of the Ontrack Core Fund along with Lee Harris. Lee and I have worked together closely over a number of years, and we have a very close alignment in our investment philosophies and investment approach. We manage together 1 mutual fund and 4 hedge funds. In reality, on a practical basis, I am the lead manager on the hedge funds, and Lee is my backup. Lee is the lead manager on the mutual fund, and I'm his backup. But in reality, there's very little light between the philosophies, behind the risk, behind the approach that we use to manage all 5 of those funds. And so with that brief introduction, let me turn the presentation today over to Lee.
Hi, my name's Lee, and recently Michael and I did a video presentation that we distributed to a number of advisors. And if you would like to see that, it was talked about leveraging low volatility portfolios and some opportunities that we saw in the current market environment. But you're welcome to contact Brian if you'd like a copy of that. What I want to do today is just briefly summarize what we talked about in that presentation, as well as talk about our investment process and portfolio construction. So let me get right into it. This is a fast track slide. The green line is a chart of the New York Stock Exchange Composite Index for the 4 years preceding 2020. So from December 2015 to December 2019. The red line is just a average of 7 low volatility select bond and income funds. They were chosen just to represent this style of low volatility mutual funds, and they don't represent what we're invested in. They're just presented to show a concept. I'll show you a chart of historical performance of the Ontrack Core Fund later on in the presentation. Now the red line is that average. And this fast track chart shows you a couple of different things. One of them is a measurement of risk, standard deviation. Just one of many different measurements of risk, but it happens to be the one that Fast Track uses on their slides. The lower the standard deviation, the less risk and less volatile the issue is that you're looking at in the chart. For the New York Stock Exchange Composite Index, for this 4-year period, standard deviation was 3.49%. These low volatility funds, the average of these low volatility funds was 0.18%. That's a significant difference, almost a 20-to-1 difference in volatility and risk between New York Stock Exchange Composite and this average of low volatility funds. Max drawdown is equally significant. Max drawdown of the overall market, 21.03% during this 4-year period. And the low volatility funds had a remarkable 0.68% drawdown. So you can not only visually see the low volatility in the chart, but it also reflects in those numbers. Now, up in the upper right-hand corner over here, it shows that the annualized rate of return of the average of these low volatility funds was 4.42%. Now, that's a little low for what we consider when we're looking to leverage a group of mutual funds. The risk-reward ratio just isn't there when you consider the cost of leverage. Let's take a look at this year. In 2020, obviously we had the pandemic, and that caused the bear market decline in the February-March timeframe. Look what happened to the average of these low volatility funds during this period. It went from 0.18 standard deviation to 4.02. And the drawdown of the last 4 years, which was 0.68, went to 23.3% drawdown. That's just a remarkable change in these funds. So what happened? Well, what happened was liquidity. When the market started to turn down, there just wasn't anybody out there who was willing to buy these funds. And when the Fed said they were going to provide all the liquidity that the markets needed, then both the stock markets and the bond markets turned up. Now, while we were in this decline, we were thinking this was an opportunity in the making. This dislocation between the price before the pandemic and the price now was just not going to last. The interest that these bonds were paying wasn't changing. The makeup of these bond portfolios weren't changing. So this dislocation, we felt, was something that we could take advantage of once the decline stopped. Now, one of the things that Fast Track does is let you measure the performance of a fund between 2 different points on the chart. So I'm going to display the point between where this initial surge off the March low ended and up until about the end of May. So that's what you see here. And when Fast Track shows you the performance over in the upper right side, BP is between the poles. So the performance for that period between those poles is 5.41%, or 51.43% annualized. Tremendous difference between what is normal for these types of funds. 4.48% was what it was for the previous 4 years, and now for this period of time is returning 51%. So what we see here is a tremendous opportunity. We did not think that it was going to continue at a 51% rate for a very long time. But we thought that it wouldn't be long, or at some point, these types of funds would return to their pre-COVID prices. We didn't know whether that was going to take 3 months or 6 months or 3 years or 6 years. But we knew until it reached that back at that equilibrium point, that it was an opportunity that we might be able to take advantage of. So let's just look at the last 3 months from the time I made up these charts. The low volatility funds had returned to their standard deviation about 0.17%, so back within historical norms. Max drawdown was a very minuscule 0.004%. But look at the annualized rate of return, 10.38%. Now that is something that we felt that we could take advantage of by leveraging, whereas the 4.48 was not sufficient as far as a risk-reward ratio. The 10.38% annualized return certainly was. So this low volatility average, 200% invested, is now what you see in the blue line. So let's look at the figures for the leveraged portfolio. Standard deviation doubled, as you would expect, because we're 200% invested, minus the cost of the leverage. Max drawdown increased, almost doubled, but both the portfolio risk, looking at it visually and in the numbers, are significantly less than what you would find in the overall stock market. So people say, if you're 200% invested, that's way too volatile for me. I don't want to invest in that. Well, the concept that we're showing here is that you can be 200% invested, and depending on what you're invested in, you can be a lot less volatile than the overall stock market. And this 9.05% annualized return is a very good risk-adjusted return. So let me talk to you a little bit about our investment process and portfolio construction. We use a systematic approach to investing. We look at technical indicators, and we look at fundamental macro indicators such as Fed policy, such as, are we in a pandemic? Are we within 2 weeks of a very contentious election? But all of our portfolios are actively managed, and our primary focus is on risk management and capital preservation. Our goal is to avoid the kind of life-changing losses that many investors see and experience during steep bear market declines. Now, we use a flexible approach to investing. So although we're focused on risk management, when market conditions are favorable, we have the ability to become more aggressive and try to take advantage, as we just talked about, of favorable market conditions. We do this by looking at a lot of charts. We look at charts for the major market trends. We look at long-term trends, intermediate-term trends, and short-term trends. We look at the relative strength of various sectors. We want to see if defensive sectors are outperforming. We want to see if the small caps are outperforming large caps, how technology is doing relative to the rest of the market. All those kind of factors enter into our thinking. Portfolio risk and volatility are always forefront in our minds. Risk management, as I've said, and I'll continue to say, is key to our investment approach. And we use the charts to do the ultimate selection of the investments that we select. We utilize a number of indicators, technical indicators. Those of you who are listening in are financial professionals, and so you know what market breadth means. It gives us a way to look underneath the hood to see what's going on in the markets. So we look to see whether the market's overbought or oversold. We look at various indicators like the McClellan oscillator and the advanced decline line. The advanced decline line is reaching new highs, and the overall stock market is in an uptrend but hasn't yet reached new highs. Chances are that it will, and we might be able to take advantage of that. Similarly, if the advanced decline line is diverging with the overall stock market, either positively or negatively, that's something else that we'd want to know and watch. Moving averages and support and resistance lines are just ways to further clarify trends. They're also very useful in determining where we're going to establish stops for the positions that we do hold. Instrument selection is depending on these variables. Trend direction, Liquidity, we always want to be able to sell or reduce a position that we have without impacting that, if the mutual fund without impacting the price. We also want to maintain those relationships with those funds that we own, those fund families. So we're looking for funds that have good liquidity. Volatility is a thread that you'll see throughout this presentation. We're looking for low volatility instruments that we can leverage. And our exposure will vary depending on the market conditions. We can go from 0% invested, meaning all cash, which we've done during the waterfall declines that happen periodically, like it happened at the beginning of this year, to about 300% invested. Now, to be truthful, the highest we've been invested is around 200%, but under extremely favorable conditions, we have the capacity to go to about 300%. We make investments when the technical indicators are positive. We invest in stocks that are in funds that are trending up, and we'll sell when they start to turn down. And our technical indicators give us an indication of when the market is changing. Now, just because the market is changing doesn't mean we're going to sell what we own, but it will certainly pique our interest, and we'll hold those instruments until they turn down, regardless of what the market is doing. Talked about our use of leverage. Our favorite technique is to leverage low volatility mutual funds. And we do that in the Ontrack Core Fund through swaps. Open-end mutual funds are limited in the amount of margin that they can use. And so we get our leverage through swaps. And we pay about maybe a little bit more than what we would normally pay for margin, but that's how we get our leverage. Again, our focus is on liquidity, so that if we are leveraged, we can deleverage, or we can liquidate a position if we need to. When the markets turn down and the positions that we hold are turning down, we'll evaluate them one by one. And if they reach our stops, we will either hedge, exchange, or liquidate those positions. When we do see a position that we have turned down, if it hits our stops and the rest of the market is trending up, say our position just got overextended and it's coming back down, then we may not sell at that stop. We'll make a rational decision of whether we'll sell here, but we'll always ask the question, if not now, when? If we're not going to sell it now, then when are we going to sell it? If we don't have a good answer to that question about when we would sell it, then chances are we'll just go ahead and sell the position. We always have a stop set for the positions that we own. So our goal is on risk management and risk-adjusted returns. So this is a chart of the Ontrack Core Fund for this year. As you can see, standard deviation 1.64. So that includes the drawdown that we had during that bear market. Our drawdown was about 4.72%, as you see on the slide, whereas the New York Stock Exchange Composite was 38.11%. This chart really is a good illustration of what we're trying to accomplish with our flexible investment approach. We want to avoid those losses when the market is turning down. In this case, for a period of time, we went to all cash, as I mentioned earlier. It really didn't matter to us at this point whether that market dropped 38% or continued down another 38% or went down 90% like the NASDAQ did back in the 2000-2002 bear market. Those who were invested in the Ontrack Core Fund were safely positioned and just waiting for the next rally and bull market to start. And then when that happened, well, I talked about how we tried to take advantage of what was going on in the markets. So this has been Michael's investment approach in the hedge funds for 20 years. And we converted the Ontrack Core Fund. It was one of the hedge funds that Michael managed. We converted to the Ontrack Core Fund in January of 2013, and we've continued to use those investment principles that we had in the hedge fund now that we're managing it in the open-end mutual fund. One thing I would like to point out is that our focus has been and always will be on risk management. Michael and I are fully vested in the funds that we manage. All of Michael's investable assets, all of my investable assets are in those funds. So what happens to your money if you're invested with us is also happening to our money. I'll close and turn it back over to Brian, but as I do, I want you to know that we call it the Ontrack Core Fund for a reason. We think this fund is a good core position in an advisor's or an individual's portfolio. There's been a lot of talk about the 60-40 breakdown, how the 40% part of that breakdown, the bonds, how effective that's going to be moving forward with rates as low as they are. Well, a fund like the Ontrack Core Fund may be a good spot in that 40 part of that 60-40 portfolio. But regardless, we think that it would be a good core fund in anybody's portfolio. With that, I'll turn it back over to you, Brian.
Great, thanks, Lee. Thanks, Michael. I thought it was a fantastic presentation. I think the chart that's up in front of us really tells a fantastic story about just what it is that you all are doing down there and doing very successfully as it's reflected in the fund, its performance, and its Morningstar rating. As I mentioned at the opening, we have a question and answer period that we'll start right now. For the folks that are listening in, if you have a question, we already have a number coming in, but if you have a question, please submit those through the Q&A interface for this webinar. That would be greatly appreciated. We are on a time limit, so we'll try to get to as many as we can. First question that has come in your presentation, you focused a lot on bond and income funds. Do you invest exclusively in these types of funds?
Yeah, Brian, this is Michael. The answer to that is no, absolutely not. If you looked at what we're invested in at various times, you would assume that we were anything from investors in bonds or large cap stocks or small cap stocks. The one constant that permeates everything we do is our focus on risk management. It's not the type of assets that we invest in. In fact, if you looked at it, the mutual fund existed as a hedge fund only, but if you look back in the early 2000s, you would have thought we were a small cap value investor. If you looked at what we were invested in following the 2008 bear market, you would assume that we were an all junk bond fund. If you look at what we own right now at the moment, you would assume that we invest primarily in very, very low volatility income funds. And that's because we have positioned ourselves to be very conservative as we're in this volatile period leading up to and surrounding the election. Our concern is with volatility and risk. We always want to protect our personal money as well as our investors' money. It's all the same. And we want to protect that against the deep, life-changing drawdowns that can occur in the market. So the answer is no, we invest with wherever we see the best risk-adjusted opportunity and put the portfolio together so as to minimize the risk to our investments.
Well, that's great to hear, and a great answer to that question, and it certainly speaks to the great success that you've had as well. It's good to know that flexibility is there. Next question: as an advisor, the cost of margin Okay, this is me speaking as an advisor. As an advisor, the cost of margin usually keeps me from using margin in accounts. How does the cost of leverage affect your ability to leverage low volatility portfolios?
This is Michael again. I'll take that one too. When I started managing money, like many, or I would say most money managers, I started with individual accounts, and I had already developed my approach to investing, and it involved using margin, and it was very frustrating using margin in individual clients' accounts because the cost of margin varied significantly depending on the size of the account, and the cost of margin, quite frankly, was high. And so it was a challenge, and it was one of the primary reasons that we switched over our structure to a hedge fund structure and then later added to mutual fund, because it is just much more advantageous to use margin and or other forms of leverage in an entity because of the asset size. So for example, in the mutual fund, we don't use margin per se, but we use swaps, as Lee mentioned, which are very similar in terms of the effect to as margin. And to do that, there's a cost. There's always a cost involved in using margin, but it's low compared to what most individuals pay. And particularly right now, the cost of all forms of borrowed money is low. So, and it varies depending on what we're invested in. So right now it's in the neighborhood of 2% is our cost for leveraging mutual funds. The cost of leveraging ETFs or individual stocks is much less than that. But the cost of using leverage is much less for an entity, a mutual fund or a hedge fund, than it is for individuals, generally speaking. And the other aspect of that is that we can use the forms of leverage that we're currently using in all kinds of accounts, because we're only managing one account, one mutual fund account. And so while individual accounts, it's very, very problematic to consider using any form of leverage in retirement accounts and tax deferred accounts. But there is no tax consequence to investing IRAs or other tax deferred accounts in our mutual fund. And so this is one of the things that we provide as an advantage to our clients. Many of our friends and neighbors and family are invested in this mutual fund. And of course, we want to do the very best we can with them. And as Lee's presentation pointed out, sometimes it's just really a no-brainer to use leverage in low volatility funds because it keeps the volatility and the risk in the overall portfolio very low, even though we're adding that leverage. So we're believers in selective use of leverage, and the cost, particularly right now, is very low. But if I were managing individual accounts, it'd be much more problematic, much more difficult.
So that makes a lot of sense. I thought it was a very articulate answer. Thanks, Michael, and certainly speaks to the advantages of being able to manage a mutual fund, and ultimately making the case why some folks should look at outsourcing this types of investment management to a manager in a mutual fund, like yourself. Next question, sort of along those lines too of the leverage. Lee noted that a 4% unleveraged return was too low, and a 10% was very attractive. Do you have a number that you're specifically looking for when you are targeting returns?
This is Lee. There's no specific number that we look toward. It really depends on the market environment. I don't expect that the 10% that we're seeing now to continue to last. I think eventually that's going to go back down, as I mentioned in the presentation, to the historical 4 to 5% return of these low volatility funds. And as it gets back to that low, we'll be looking for other sectors or areas of the market to invest in. So while we'd like to continue investing in this set of funds that we're in now, we are active managers, and we will move to a better performing area of the market or better performing funds as the market presents itself.
Great. Yeah, that makes a lot of sense, and thanks for that insight. Couple more questions that we have in the queue. Just a reminder, if anybody has any more questions, please submit those through the question and answer interface. We are coming up on our time limit here shortly. Next question. I think it's kind of related, but maybe longer term. Is there a target is there a target for returns over a market cycle? If someone were to hold this fund over an entire market cycle, is there a target of total return that you're looking for?
Now, this is Michael. I'll be happy to take that one, and the answer is, I wish. I already know exactly how much return each one of our investors wants, and that's important because each investor wants all the return they can possibly get, and you can put me in that camp too. That's exactly how much I want. What differentiates us as investors is not how much return we want, it's how much risk can we afford to take. So the market provides the returns, and we have to work within the parameters that are given to us by the market. What we can control is how much risk we take. So we manage risk, and the market provides a return. I have had years where we have made over 50% in a year, and people look at that and say, "Boy, you must have taken a lot of risk." And the truth is, no. In those very high return years, we didn't take a lot of risk. We didn't take any more risk than we're taking today, or that we've taken at other times where we've made essentially nothing. The key is what's the market environment? Sometimes the market just makes it very easy. So for me to say, well, I'm going to target over on an average annualized rate 10% or 12% or 15%, it would be ridiculous for me to turn down an opportunity for a 40% rate of return. So currently the annualized rate of return in the Ontrack Core Fund is running, I think, about 28%, Lee, is that correct?
Right, 27.89.
So that rate of return with the level of volatility we have is, in my opinion, exceptional. But it would be misleading for me to tell you that I intend to try to get that rate of return next year. I don't know what the rate of return will be next year. It might be 28%. It might be 0%. It might be 50%. But what I think I can say with some reasonable level of assurance is that if the market dives and the market is down 50% next year, we will not be down 50%. We are very active managers, and we'll take the steps necessary to limit the risk, just like we did in this bear market and just as we have in the last two major bear markets. You know, I might just mention in the 2002 bear market, 2001, 2002, our funds were up slightly, nothing to mention, but you know, they were flat to up a little bit, 3 or 4%. In the 2008 bear market, for the year, our funds were flat. We were within plus or minus 1% of unchanged. And Lee has shared with you what happened in this last bear market. But the important thing that Lee pointed out very carefully was that before the market bottomed, we were already in cash. So nobody knew when the market was going to bottom. And I think it's fair to say that it only bottomed at the point it did because of actions by the Federal Reserve. It could have, under different circumstances, continued down another 30 or 40%. But at that point, we were already in cash. So yes, we had a 4-something%, I think, drawdown. And if the market had gone down twice as much, that's still all the drawdown we would have had. So we don't target returns, we target levels of risk. We are oriented, we are a core fund. We are the kind of fund that people put in their portfolio and forget about it. That's the majority of our investors are there for the long haul, and that's the way we manage the money, is for those investors, many of whom are our friends, our neighbors, and our relatives, and ourselves.
Well, Michael, I'm very impressed with that answer. I thought it was very well done, and it states, you know, what you guys are trying to do, and obviously the proof is in the pudding. And so it's not targeting returns; it's more about targeting risk. In other words, you know, the tail's not going to wag the dog, right?
That's correct.
Great. Well, we have run up on our time limit for today's webinar. I thought we've covered a lot of good ground here in terms of understanding how the money is managed and the philosophy behind it. We answered some really good questions as well. So we're going to have to wrap up. But for everybody out there, I certainly thank you for joining us. I hope you found the presentation to be informative. Again, we've recorded this webinar so we can make it available to you. And as a matter of follow-up, we will certainly be reaching out to everybody who attended. But in the meantime, if you're looking for more information, please visit ontrackcore.com. Again, ontrackcore.com. That's for the Ontrack Core Mutual Fund, or advisorspreferred.com. And again, that's where I head up the distribution for advisorspreferred.com, sub-advised fund family. And again, for this fund specifically, ontrackcore.com. Tomorrow, in this series of webinars, we'll be hosting flexible plan investments, and on Thursday we'll have Spectrum Financial. We think this is a fantastic series, and certainly very, very timely. We hope to see you here again tomorrow at the same time. And with that, I thank you again, and have a good night.